U.S. natural gas futures climbed above $2.60 per million British thermal units after reaching a one-month low of $2.31 earlier this week. The recovery in output following the Arctic freeze has been slow, with average gas production in January declining to 102.8 billion cubic feet per day, compared to December's record high of 108 billion. Furthermore, the volume of gas supplied to U.S. liquefied natural gas export facilities continued to rise. Notably, U.S. pipeline exports to Mexico saw an increase, averaging 5.7 billion cubic feet per day in January, up from December's 4.7, but still below the monthly peak of 7 billion cubic feet per day in August. Analysts foresee a surge in exports to Mexico once New Fortress Energy's LNG export plant in Altamira becomes operational. Despite these developments, heating demand is anticipated to remain subdued, as meteorologists predict above-average temperatures persisting until at least February 7. The coming 15-day U.S. weather pattern is the warmest of the past 45 years, as much warmer than normal temperatures rule most of the U.S. Meanwhile, there will be colder weather systems in the western U.S. February 3 to 5, which then have the potential to advance eastward February 6 to 10 for the next best chance of a colder or closer to seasonal U.S. weather pattern. Moreover, if the colder trend continues to develop until the end of the week and coincides with a super bullish storage report on Thursday, we may see a gas price uptick at the end of the week. European natural gas futures rose above €28 per megawatt-hour, slightly above a 6-month low, as Qatar faces delays in shipping to Europe due to conflicts in the Red Sea. Ship tracking data showed that since January 15, at least 6 shipments to Europe have taken longer routes around the Cape of Good Hope instead of the Red Sea and Suez Canal. Nevertheless, milder European temperatures, ample gas reserves, and increased wind power generation from Stormish's strong winds pushed European natural gas prices to a 6-month low of €27 earlier in the week. Gas storage levels in the EU on January 22 stood at 74%, with Germany at 77%, Italy at 70%, and France at 64%. Given the interplay of these factors, the short-term outlook for U.S. natural gas futures leans towards a cautious bullish sentiment. However, the potential for demand fluctuations due to changing weather conditions suggests a volatile market landscape where gains might be short-lived, offering traders opportunities for shorting in the near future. Considering the current bearish supply situation and a pessimistic demand outlook, the market is poised to attract sellers once it reaches a favorable price level. The initial target is the 50-day moving average at $2.76. We anticipate new sellers to emerge upon the first test of this level. Surpassing it, however, could trigger a further rally towards the minor resistance at $2.87. The optimal shorting zone is the price cluster formed by the primary resistance at $3 and the 200-day moving average at $2.98. However, given the underlying fundamentals, it is unlikely that the market will reach this zone. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.